U.S. hiring numbers were higher than expected. Inflation continues its bumpy ride. U.S. economic growth extended its solid streak. The Fed cut rates twice. Trump won the presidential election. The stock market took a dip. But despite that, the market had the best 2 years in a quarter century. That plus a general retirement planning overview, as usual, and more in this quarterly context webinar. Watch to stay relaxed by staying informed and remain current about things that actually matter to staying focused on your long-term goals and retirement readiness strategy. Welcome to the WealthStep quarterly context for the fourth quarter of 2024. WealthStep is an online financial guide to help 401k plan participants and other individuals make smart decisions about how much money they need to retire and how to save, how much to save, how to invest now and by life stage, and how to get to retirement readiness. These webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help you stay more relaxed by staying informed and make better decisions towards your goals. We try to keep the presentation to about 15 minutes, and recordings will be put on the blog at wealthstep.com. Pass it on to people you know and care about to help them achieve retirement readiness as well. Aim, save, and invest are the key areas for achieving retirement readiness. We'll cover some of that, as well as other dynamics for better long-term decisions, and then part two, a quick retirement readiness overview. As always, we encourage you to focus on the space between what you can control and things that matter. You can't control markets, you can't control your decisions, you can define your goals, you can determine how much you should save and to do it consistently. You can focus on life stage investing and being a disciplined investor and being diversified by using the pre-built portfolios in your retirement plan and or WealthStep direct portfolios. And you can be a strong long-term investor by continuing to invest and stay disciplined through market bumps when they occur. As always, there are news items that cause the market to bump around a little bit. Budget deficits are projected to be larger. That may complicate the economy in the long run. Inflation showed some mixed numbers, making some economists and the Fed a little bit nervous. U.S. growth streak continues, even though there's some signs of a weakening economy and the possibility of a recession on the horizon somewhere. The election happened with a new president coming into town in a few months. The Fed cut rates. The Fed cut rates again. Markets cooled. And as mentioned, overall, though, despite some little bit wobbly numbers, very strong 2-year returns. So we've now seen 3 Federal Reserve cuts since the 11 hikes that occurred starting during the end of the COVID period in an attempt by the Federal Reserve to control inflation. That's one of the tools that the Fed has. By raising rates, it slows economic growth and thereby slows inflation, because in the long run, inflation does a lot more damage than higher rates, even though higher rates can be uncomfortable and painful for some people in the short run. Inflation has cooled, luckily, from a high in the last few decades of 9% down to about 2.5%, hovering around that number. The stock market was around 2.5%, and bond markets, despite the cut in rates, were negative to the tune of about 3%. Normally, when the Fed cuts rates, that causes bond prices to go up, but because of nervousness about inflation, bonds actually went the other direction, nervous that if inflation picks up speed, that the Fed may have to raise rates and bond markets would then be negative. So the bond market is nervously anticipating some possibility of an increase in rates down the line, or at least having rates stay higher for longer. Overall unemployment is hovering around that 4.1, 4.2% range, and economic growth around 3% in the last quarter, but projected to be cooler, closer to 2%. In the not too distant future. This environment favored the US stock market, in particular what are called the mega cap stocks, or the Magnificent Seven. Seven of the largest companies in the US. Non-Magnificent Seven stocks didn't perform quite as well as that small group, which represents about 35% of the S&P 500 index. So the S&P 500 index is been increasingly looking a bit like a sector fund with so much focus on such a small number of stocks, and that can create some volatility potentially in the future. In the meantime, international stocks cooled, as well as real estate, with nervousness about where rates might go and where rates might stay higher for longer. And for an interest rate sensitive sector of the market, that tends to make real estate investors nervous. As mentioned, the bond market dropped in the US, but was positive abroad. Overall, still, if we look at the 10-year numbers as well as year-to-date numbers and other numbers, large cap growth continues to do especially well. We highly encourage investors not to get overexcited about segments of the market that have done especially well, because that tends to precede some cooling, because markets are cyclical, and the elements of the market that are out of favor tend to come back into favor, and those that are very in favor currently tend to cool off. And so that's just a natural part of the markets. So it's better to stick with, in the long run, a diversified portfolio that automatically captures the elements that are out of favor as well in the future, by remaining diversified across all sectors in the US and abroad. Continued talks about recession, what will happen, when. Economists are not clear. There's no specific consensus other than the general expectation that the economy is cooling and may continue to cool after a period of relative strength, but overall still solid economy. Inflation, as mentioned, has cooled. That's given the Fed the confidence to lower rates twice by a quarter percentage point, and some of that lowering of inflation has come from oil prices as well as other parts of the market. Interestingly, this is the Fed interest rate chart. So was brought up before the global financial crisis, then brought down to help stimulate the economy, ratcheted up after the global financial crisis market recovery, then brought back down during COVID to stimulate the economy and try to help prevent a depression. And then that stimulation over this longer time period here, over about 10 years or more, that tends to increase spending in the long run, and inflation. Inflation did pick up. The Fed ratcheted up rates to try and rein in inflation, which was effective, and now is beginning to bring rates back down. What's interesting is that the market generally believes rates will stay closer to 4% for a couple of years, whereas the Fed expects market rates to come down, the Fed rates to come back down closer to 3%. And as a reminder, it's not too long now since, now that rates have come back up, that money market funds and other types of returning cash vehicles are paying a lot more than they used to. So for money that is not your long-term money that you're going to be spending sometime soon or in the next few years, that shouldn't be in a long-term strategy, it's much better to have it in something like a money market mutual fund or something similar, rather than just sitting in a savings or a checking account that would earn 0%, whereas money market funds are somewhere in the 4.5% to 5% range. Although that, as the Fed cuts rates, that will probably creep down pretty soon, a little closer to 4%, but still a lot higher than 0. Now we'll do a quick review of retirement readiness preparation concepts, and it's even better to see the full video at in the video section of WealthStep for a more complete discussion of concepts and so forth. And the key elements that we want you to think about are, there are certain decisions that matter most. That the most important one is making sure you save the right amount. That's one of the key retirement plan basics, as well as how to avoid emotional investing. And the biggest way to do that, and the easiest way, is to know what stock bond mix is appropriate for each life stage for you. That makes it easy to know you're on track, knowing you're doing the right thing, so you don't have to be concerned when markets get bumpy. And then it's important to know what risks are. Some people think of market volatility as the primary risk, when in reality, emotional investing mistakes and inflation are much bigger risks in the long run. So these are, again, concepts that we go into in more detail in the full video. For now, I'll just remind you that AIM is about figuring out how much you might need to be able to stop working or to work less. Save is about how much you should be saving now per year towards that goal. We generally recommend 10 to 15% as a starting point if you're not sure. If you are in your early 20s, sometimes people can save a little bit less than that. If you're late in the game for saving and you're a little older and you haven't saved enough and you're planning on retiring in a normal age especially, you may need to save considerably more than 15%. Some people, however, are choosing to stick with something in the 10 to 15 to 20% range and then just work longer if they started a lot later. But the sooner you start, the better off and the easier it's going to be in the future. And then investing is about making the right choices, the right stock bond mix for each life stage, and doing that can make it pretty easy. We'll show you something, sort of a simple overview of that in a few minutes. One of the things we see over time is a pattern of comments that people make over thousands of conversations or interactions with plan participants and hundreds of meetings over the years, and lots of people. The pattern is that the younger people are, the more they think, oh, I'll just deal with it later, and the older people are, the more they wish they had started younger. So take the advice of those people that you know that started late and wish they had started sooner. Can make your life a lot easier and give you a lot more flexibility down the line in terms of when you can retire, especially if you have any kind of interest in retiring early. You're going to have to save more and sooner. Markets in the big picture boil down to three things: stocks, bonds, and cash, or something that's cash-like, and then inflation is a factor to fight against. So stocks have longer, higher long-term returns, but are bumpier along the way. So there's a reward for that bumpiness. Bonds are also can be a little bit bumpy, but not nearly as bumpy as stocks, but have a lot lower return. This is a growth of $1 over about 100 years. US Treasury bills, which are you could think of as kind of enhanced cash or something like a money market fund, but not quite, but roughly in that type of investment category. Very smooth ride, but very low return in the long run, and just barely beats inflation. So if you are doing nothing with your money, for example, if you have a big chunk of money in a savings account, it would really be like this flat line down here, earning 0% or close to 0%, and losing against inflation every single day, every year, every week, every month. So the idea is to figure out or use the advice of something like WealthStep to determine what the right stock bond mix is for each life stage, or if you're using a target date fund, that makes it even easier. So let's talk about that now. Some WealthStep 401k plans use target allocation funds. So there's a certain stock bond mix that corresponds with different life stages or ages here, and target date funds, whereas the target allocation funds, you must make those changes yourself. Target date funds do that automatically for you over time, so that you don't have to really do anything yourself. You just need to choose the year of a fund. For example, a 2050 fund would be for someone who's planning to retire roughly around the year 2050. And the rest is done automatically for you in the background. And the investor behavior dynamic, the emotional investing studies show that people who invest consistently and don't make changes emotionally tend to have a lot higher return than those that make a lot of changes because of fear or greed. This example is just a 100% stock portfolio over 20 years as a simple example, but someone who just stuck with it got about an 8% return over this time period, and someone who got in and out had about half that. And that is a huge difference in terms of return and makes it a lot harder to retire, and means you would have to save a whole lot more money in order to get to the same place towards your retirement readiness. So being a disciplined investor helps you grow your account in the long run. So WealthStep has multiple advice components. There's the planning and saving component, which helps you figure out that aim number as well as your spend and your save number. The investment advice component is built around certain life stages to help guide you in terms of what stock bond mix or what portfolio might be appropriate. And there's the education video that we referenced to get a more complete view of these topics. And WealthStep has multiple services. Some are for 401k plans, some are for individuals outside of 401k plans, and then there is a digital only option for companies and individuals, and then there's a general basic advice tool which doesn't access the advanced elements of the savings and planning tool, but still helpful. And this is designed for the general public, for people who may not be part of a 401k plan or may not be able to afford an advisor. There are fees for the first three categories, although it may be covered by your company, and the basic version is free to the public. So aim, save, and invest wisely so that you can spend appropriately. And spending the right amount so that you don't run out of money is also important. There's guidance around that within the WealthStep tool as well. So thank you for being with us today, and we wish you all the best.